And I've been doing this for a few years, and I can tell you that this is the most widely anticipated panel in my tenure here with the World Economic Forum. On behalf of Bloomberg, I'm thrilled to be here. And putting this panel together was without question the most fun and most challenging, and any number of government officials said, maybe not. And we are thrilled to have these three important individuals with us today. I will get through the introductions quickly. You know many of these people and can learn more about them later and their prodigious abilities and career. And then we'll dive into a discussion very much centered around the present debate of negative interest rates. The title is No Safe Asset. Where is a safe asset? What is a safe asset? Everyone, as you know, is more than fat and happy after 2019. I saw the 60-40 split. Ann knows this cold. Bonds up, price up, yield down, equities up. 2019 was brilliant. Think where we were a year ago. You were on medication a year ago, weren't you? But let me begin, and I'm just thrilled to do this panel. Paco Ibarra joined us here at the last moment, and I'm just ecstatic. There are commercial bankers, there are managers managing and messaging, and then there are people that do. Mr. Ibarra is one of the people in Too Big to Fail Banking who actually does every day. What's the first thing you look at when you come in the morning? I don't want to give away the secret sauce, but...
Where am I going to get my coffee from?
We're going to get your coffee from, and hopefully good Spanish coffee. But we are thrilled he could join us, and particularly about what I've heard in so many interviews, which is the profound effect of what we have wrought on commercial banking and on the money illusion, as Ken Rogoff talks about so much. I'll talk about his book here in a moment. Ann Richards joined me with Ken 2-3 years ago on a wonderful panel. She does two things. She represents the investment world dealing with this new rate structure, and as she calls it brilliantly, actuarial hope, which perfectly personifies where we are, but brings to it a prodigious mathematics ability with electrical engineering, as a school to the north of London. A bit to the north, Edinburgh, and really brings a truly wonderful mathematics. Kenneth Rogoff, to many of you, needs no introduction. His book, The Curse of Cash, was my book of the year a few years ago. It is the most courageous book I've seen in economics in my career, frankly, in my lifetime. Ken and I grew up, 42 blocks from each other in a small city in upstate New York, and he has gone on to just shockingly wonderful ability. But The Curse of Cash, there were death threats, there were threats.
I'm north of 20.
North of 20. Mm-hmm. A profoundly courageous book, and that'll be the centerpiece, the theoretical foundation to this discussion of where we are right now. I can't say enough about his book. It should be read and reread. Throw it at every 25-year-old you know that has every answer. And particularly focus on Chapter 8 as the linchpin of beginning on negative rates. Even more important, the book is more important now than it was when it first came out a few years ago. So let's dive into this. Ann, I'm going to begin with you. What's the biggest headache of the idea of the dynamics of assets and the reality of negative interest rates that you live with every day at Fidelity in London?
So I think that the biggest challenge is when you look at things from our client perspective, is, across much of the world, populations are aging. And as you have more and more of the population moving towards a retirement phase, their demand and their need for stable income is really high. And our challenge is how in a world where bond markets don't give you income very much anymore, how on earth do you shape a portfolio that grows into and grows with them in terms of giving them that stability of income? And that's the challenge we wrestle with every single day.
The dynamics of that now, the challenge now is clearly different than 08, 09. How do you look, and I'm going to go out longer term here, at 2025, given where we are right now?
So I think there's a couple of different lenses to put on that, just thinking purely from an asset level. There are pockets where you can still find yield that certainly are below the level, obviously, of the where historically, but nonetheless do offer a degree of income stability, but they tend to be in parts of the world where we associate less with the safety. So the idea that you can go into a safe government bond market somewhere and get some stability of income, we've largely lost that. So, parts of Asia, absolutely, you can still find yield, and we anticipate that because there's a growing demographic, that will continue to be the case out to 2025. But you have to start to look at things really starting from the risk perspective, understanding that the safe asset doesn't really exist, probably never existed, but it certainly doesn't today. So you have to find other pockets, for example, real assets that have contractual income associated with them, that give you a different risk. They don't give you no risk, but they give you a different risk. And I think that's where we're shaping. Portfolios are more complex. They have to be multi-asset in order to provide a degree of risk diversification that underpins that.
My takeaway there is Fidelity's buying Oriental carpets. Paco, you live this on the other side. Your industry, I think, has been wonderfully eloquent about the week-to-week, month-to-month, quarter-to-quarter reality of what has been wrought on the theory of negative interest rates. Give us a window into how you deal. You look at the BTMM screen on the Bloomberg. How do you deal with that day to day at Citigroup?
So fortunately for us, our core balance sheet is U.S. based, and we don't have the same pressure that European banks are having with their own yield curve. But it's not more than a day-to-day question. It's a fundamental question of how do you make money as a bank in an environment of negative rates, and particularly knowing that a significant part of your profitability is dependent on your liability business, and that liability business traditionally has produced money by you keeping a percentage of the rate. Now, a business model that gives you a percentage of the rate doesn't work very well when the rate is zero. And that is what's fundamentally going on, because it is very difficult to switch from that revenue model to an alternative model that is a fee model or something like that. So negative rates make things even worse, because you cannot even charge the negative rate to do that. So you lose one of the engines of the plane in a way when you operate in an environment of negative rates. I think a similar thing happens with the asset management industry, by the way. It's not the same concept, but it's very difficult to charge 50 basis points when the risk-free rate is zero. And it's much easier to do that when the risk-free rate is 400 basis points. And that is creating other effects. I think maybe, and we can discuss that further, maybe the explanation behind the move to passive asset management, and the move towards private equity models and more illiquid stuff, the kind of things that we heard just a minute ago, has a lot to do with that rate.
Can you commit hedges in this environment? Can you still hedge a larger portfolio with efficacy?
Well, there's not. I mean, you hedge, you lock in the very low rate anyway. When we had zero rates in the U.S., or very close to zero rates in the U.S. last, banks were at least had the opportunity to hedge in the medium term, and there was a positive rate there. So you could pay zero to deposits and make, as you hedge part of that was considered to be permanent liquidity, you could hedge part of that in the 5-year. But with a yield curve that is so flat or zero or close to zero, and that doesn't give you that opportunity. So hedging, if that is what you refer to, doesn't really help.
Ken, I had our good panelists here begin, because I wanted to get a framework there of the investment world and the banking world. Ken, your book's charm from page 1 is you realize there's a real economy out there, unlike other international leading macro economists as well. Have you been surprised at the commercial and investment struggle over what you people have wrought?
Well, I think Anne and Paco are in different industries and face somewhat different problems. So I think the problems Anne is talking about would be no different if the inflation rate were 8% and the interest rate were 6%, and somebody wanted to retire and they're watching the value of their savings dwindle. And we've heard that conversation, at least you and I, Tom, certainly heard that conversation in the 70s, the early 80s. In fact, if you look at advanced countries over history, it's not an unusual situation. And beyond that, even the longer term returns are uncertain. The stock market's done very well, but there's not necessarily any expectation that it will be going forward. We economists, rightly or wrongly, think that monetary policy only sort of affects a little bit of the timing of this, but it's not the fundamental driver of where the interest rate is relative to the inflation rate. We think the fundamental drivers are savings, investment, demographics, risk. So you've heard a lot of talk about these things. So the reason the nominal rate, the rate you actually see, could be negative at the short rate is that inflation's very low and inflation expectations are low. Now, in the banking world, it's a different question, because the question is, can you pass on the negative rates to your depositors? Because if you can't, then you have to find indirect ways to pass it on. And I think most studies show that that's not very satisfactory. You can charge more, you can require people to hold balances, but it's very difficult. I would say this reflects a few things. One is it takes time, and studies at the European Central Bank have found that the pass-through to depositors has really been starting to take place, at least in the healthy banks. The pass-through has been 1-for-1 or more now in negative rates to the larger depositors, not to the ones under 100,000 as yet. By the way, my book advocates the government just paying that difference and subsidizing them, which would insulate, except for the people at this conference, it would insulate most people from that. But it also reflects that this is not something a central bank can do on its own. The ECB can't just decide it wants minus 3% because it involves tax laws, institutional changes, regulations that it does not, even the ECB, which has much more regulatory control than the Fed, can't control. So you need preparation for this to do it effectively. And I think there's certainly been a case in some jurisdictions where they've gotten out ahead of themselves without the support of the government and making the necessary changes.
What's so important here, Ken, the grand bargain of negative rates and the ability to solve great financial turbulence such as 2007, 8, 9 is, and I'm going to use Michael Woodford here and his wonderful interest in prices, and you get these nice smooth curves, and the bargain is you use the tool for a bit, and then you smoothly return to some perfection where Paco doesn't gray. Okay, that hasn't worked out. The curve has gone on much, much longer than the original models, right?
Well, I'd say part of that is the central banks, because of all these limitations, are not in a position to say, we will do whatever it takes. When Janet Yellen...
So you're saying Mario Draghi was wrong?
No. They're not in a position to do whatever it takes to get... he saved Italy, but they're not in a position to do whatever it takes to raise inflation back to their target. Janet Yellen gave a presentation in 2016 at the big central bank conference at Jackson Hole, where she illustrated how the Fed model would have negative rates work. By the way, I used to work at the Fed. I know enough about the Fed model. I probably wouldn't be citing it if it didn't make my case that I wanted to make. It's very complicated. But anyway, she showed if you bring the short rate down, you bring the longer rates up, because people expect inflation to come back. They expect growth to be restored. If you're just able to use it a little bit, you don't get that effect, and if there are all these obstacles. So no, in principle, particularly the longer rates needn't be negative for a long time if you're able to use it effectively. I think that's a reasonable expectation.
And so, we've got so many themes to cover here, and I wanted to go 4 hours, and I think we get 45 minutes, which is unfair. The reality is the grain bargain was rates go up. Ken lays this out beautifully in the curse of cash. That's not your world, Ann. Your world is this. There's a leadenness to it. There's a weight to it. I want to get to the lack of vol with Paco in a moment. You have to extend your x-axis out, your actuarial hope, given this leadenness to the system. Do you witness that every day at Fidelity? A weight to what we're trying to do intellectually that leads to total return.
So I think we have to sort of set it in the context that if you look at 2019, it was a pretty good year regardless of which asset. I mean, you had to work quite hard to lose money in 2019.
Thank you, I did. Continue.
and so, if you think about what the tools central banks have played with, they've chosen asset prices over other things. And that was a choice. That was a choice that was made. What it has done is it has kicked certain other things down the road. So the actuarial hope point, if you're lucky enough still to have a defined benefit pension scheme, the actuarial hope point shows you that you've got a ballooning deficit between assets and liabilities because there is still this mismatch in actually what the discount rates are. But that's one of the reasons why increasingly defined benefit pension schemes don't really exist except in the public sector. But they're still out there. If you have got guaranteed or quasi-guaranteed income products across Europe, you're really struggling. But in the short term, you don't feel that pain because asset prices have gone up, and they've gone up quite a lot. So I think central banks' monetary policy, these have been really specific choices that have been made, and they have had consequences to do it. So I guess from where I come from, it's not really, in our gift to determine what the priorities of central banks should be. But we seem to have come into a world where we should just accept for the foreseeable future, whether it's to do with an aging demographic, whether it's to do with the fact that if you look back historically, somebody threw me out some really interesting numbers, which is if you go back, May 2000, 10-year treasuries, 6.6% yield. May 2009, investment-grade corporate bonds, 6.6% yield. May 2019, high-yield corporate bonds, 6.6% yield. That we've been going in one direction for a very, very, very long time. So, we shouldn't be surprised that this is a situation that we find ourselves in. So we're seeing from the people that I'm trying to invest on behalf of, that we are having to look at the capital account, if you like. It's the capital part of the total return, which is the thing that we have to focus on. And for the other part, we simply have to choose our risks.
Do you have to adjust your securities and portfolio analysis because this is a gift that's not going to keep on giving? Do you go right away to a lesser return in?
So it's a really interesting question that you kind of come to. Nobody expected, very few people expected 12 months ago that we'd have seen the returns that we've just seen in 2019. So the ability of on the a flip of monetary policy to throw petrol on the fire and to get everything going. If you've tried to bet against that for most of the last 10 years, you've tended to be on the wrong side of that trade. So it's a really hard one from a timing point of view. So the time horizon of the investor you're working with is critically important to that. The further out you look, the more choice that you have around how you blend the risks. But the predictive power when you've got central bank QE still throwing the petrol on the fire. It's very hard. And
so what's so important here, folks, is the x-axis of Ann Richards is so different than what Mr. Ybarra is working with. What do you make of the leadenness, the lack of vol? I look at FX volatility in the Bloomberg and its historicals. What do you make of that in the trenches of a moving finance?
So I see that as connected to the very, very low rates. It's almost like we're going through a bit of an ice age for financial markets when it comes to volatility that is ultimately connected to the fact that the rate and the expected return is so low. And I think there are many ways in which that manifests. One of the ways is one of the attempts to recover profitability is to try to pay less in terms of transaction costs. Some people are trading less. They are putting more pressure on the intermediation industry to recover some of that spread, which is probably, that is not a bad thing necessarily, but it is happening, and they're trying to avoid trading in assets that have significant bid offers, and I think that is reducing activity in markets and reducing liquidity to some extent as well. I think the other thing that is happening is that what you see is a move towards, one of the ways to capture profitability is moving to more illiquid stuff. And that is not necessarily riskier stuff, but it's more illiquid. And you see people having to commit their investments for much longer and buying into products where the liquidity, that will not have liquidity to capture some of that spread.
Have we forced our way, Paco, into where we were in 2006, where everybody was congratulating themselves to pick up 14 basis points on a transaction or 7 basis points on a transaction? Are we back to the stress of just making little bits of improvement along the way?
Yeah, it is when you have, at very low rates, that's what you can expect. You're not going to make much more than that. And some of it you hope, but it doesn't always happen, that will be replaced with volume, with more transactions. But if you look at the intermediation revenue of banks, for instance, on financial markets, I think there are more complicated explanations for that, but the basic number is that number is about half of what it was before the crisis, 11 or 12 years out, with GDP, nominal GDP growth in all those years, other than the crisis moment, and assets under management having multiplied. The intermediation revenues are much smaller than they were before. So there's been enormous pressure on that, and that is so we're playing for much less in that sense. One point that I would like to make on the issue of transmission of the negative rates is that, remember that it's not just the negative rate that you have to transmit, you have to transmit the margin as well. So you were making, rates were 4%, so your margin was 150 basis points.
Yes.
You're not just enough, you need the 150 basis points, which is what you cannot get as well.
You've been nodding, Ken. Listen, it's an open question to Professor Rogoff. You listen to these two on different parts of the x-axis. Your thoughts as you listen to the last stream.
Well, I want to pick up on a couple of points.
Please.
Again, I don't think the low rate environment, the low real rate environment is about central banks. It's about other forces. I think some of it's still the aftermath of the financial crisis. On the low, and one other point about you two were alluding to something that's very much in my world. I work at a big institution with a big endowment, and there are a number, and it seems to have gotten much richer. But of course, I'm sure if Anne were advising what the payout ratio should be, how much of it should you use to fund operations, well, you've gotten much richer because everyone thinks the rate of return's lower. That's inflated the price, but the flow that you're going to get out of it isn't any higher. So if you've doubled your size, you have to half what you're paying out to be sustainable.
Wealth management with Ken Rogoff.
Well, I'm picking up on your comments that I think it's something that a lot of people don't understand. And by the way, even hedging in that world, how do you hedge when when this is what's going on? And I wanted to pick up on the low volatility.
Please.
The first thing I have to say about it is I just don't think markets are very good at calling volatility. They're sort of good at, short run what's going on. But I don't think we live in a phenomenally safe world financially. Forget about the environment and everything else. I certainly see plenty of tail risk. I'm not hysterical about it. But just for example, we're going to have an election in the United States where I think it's probably 50-50 what happens.
Careful, he's in the building.
All right, I think I'm being generous. And there's a chance that it'll be quite a regime shift. And where's that, in the measures of volatility? I have to say, pension funds, we've never had pension risk like there is now. This is a new form of debt. It really didn't exist at this level 40 or 50 years ago. It swamps everything else for most cities and countries. Now, we have a lot of tools for handling it, but they're definitely tail risks. If you, for example, look at Puerto Rico and Detroit, the pension funds actually got hit a lot less than the bondholders did. I think a lot of bondholders just ignore the pensions. I don't think you can. And climate risk. Okay, that sound like, you're at Davos talking about climate risk. And look at Australia. I can't imagine what the cost of that is, of cleaning that up. We had a mini version in California. I think over the next 5 to 10 years, the fiscal costs of random environmental risk, cyber risk, there are a lot of things here about that. I'm not saying the world's going to fall apart, but the markets seem to have this nothing's ever going to happen, great moderation squared, there's just no problems. And I think we're clearly going to be in for a cold awakening on that at some point.
Can't help Paco with a lack of volatility.
Well, I can't explain the lack of volatility, so maybe he's right that it's the low rates. But what about the stock market? Is the low rates making the stock market not volatile? I don't know.
Tim Cook's not in the audience. You've got your hand up.
I do. I just because somebody was probably somebody very famous, said, as soon as a measure starts to become a target, it ceases to be of use as a measure. And I think nothing fits that better than volatility. So when I first started investing, I came into the investment world 28 years ago, volatility was quite a useful measure because it was a very good way of encapsulating in one simple number actually quite a lot of risk appetite indicators. Once people started trading volatility and targeting volatility, its use as a measure for anything, I think, became pretty meaningless. And I think we talk about volatility. We only ever worry about downside volatility. Well, volatility isn't. Volatility is up and down. So we really need to find a different measure, I think, because now volatility is a target. It's not useful as a measure.
Well, let's use the Davos sentiment, because my feeling is it's pretty calm about everything going on at the moment. I mean, this year...
So up 28%.
And it's a good
Yeah, I mean,
counter-indicator.
Absolutely, yeah. No, I think if somehow people could have their pulse measured of how worried they are about the market doing something terrible, it's at a very low level here right now.
Can I give it a try? I think, and I don't have a scientific way to say this, but I think there's probably a difference between trading volatility, or volatility you expect as the normal event volatility, and that has gone down very significantly, versus the tail event and the risk of something big happening, which I think is in the minds of everyone, together with the feeling that there is no escape, that you have to be invested somewhere. I mean, you have this need to produce some return somewhere, and the sense that even though you may be worried about an event at some point, and also an illiquidity event at some point,
right,
which I think is an interesting different topic, you still have to be invested.
I think that's well put, that distinction.
To the hedge point, Paco, do the Greek letters still work? I mean, we can go from Sharpe ratio, and I don't know where the risk-free rate is. Explain to me where it is when you figure it out. I mean, in this world, do we know the risk-free rate right now?
No such thing.
Can't use the Sharpe ratio, beta suspect as well. Do the Greek letters still work at Citigroup? When you set up derivatives, Ken mentions hedging and trying to do what we all learned to do in school. Does Delta, can you get good gamma analysis of the sophisticated stuff you're working on?
Well, they work until the market
tells you they don't.
It is, I think, so we have the systems and the risk management around these books have become much more sophisticated and just simple. And you have a lot of scenario analysis, and there's a lot of the risk is how stable liquidity is going to be in the market for you to hedge, and you have to size the book to the point where you feel comfortable.
Do you adjust that because of negative interest rates? Because the sustained low, super low, well, not super low, Ken talks about super low in the book, but the sustained negative interest rates, does that change the derivative analysis?
Well, it's just an input. I mean, it is, in this case, it's very mathematical. It's just an input that works with the models. And we had to change some models that had not considered negative interest rates in the past, but it's just one more input. The question is more fundamental, is what is you're assuming in the model that you're going to be able to do certain things to hedge the book, and that assumption is an assumption on liquidity.
Right.
It may not work in the end.
I knew he'd say this. I set you up for, and Ken, it's mathematical. Can we assume our mathematics is correct with negative interest rates? Can the glide path, can the dynamics of our release, our escape from this environment, can we assume it's conventional static or dynamic mathematics?
Well, I taught at Berkeley in the late 80s and the 1987 crash. I won't name names, but there was some Berkeley professors who had developed something called portfolio insurance, and it was great on paper, and everyone subscribed to it, and it caused the stock market crash. Because what do you know, when everyone wanted to use it at once, it was completely illiquid. And so liquidity is actually a very hard thing to mathematically model. We don't have great models of that. And so that's a real limitation of mathematical analysis with hedging. It's good in the small, but when any larger event happens, you get these illiquidities, and it's worthless.
And this is great. The front, read Obstfeld Rogoff if you want to get the world of the dynamics of Ken Rogoff. I want to go over to like Trichet, to the Newtonian engineering. That's your mathematical foundation. Forget about continuous functions. If you're in the discrete world you grew up in engineering, or Paco has to live with every day, folks, I'm selling Bloombergs here. That's the foundation of a Bloomberg. But in the discrete world, can you use his dynamic mathematics?
One of my challenges, when I came in from an engineering world into the financial world, is that because the financial world is a dynamic world, because it's a learning world, because as soon as something is a target, it adapts to it, it is really hard to build mathematical models that can keep up with that evolution, the fact that it's a learning machine. It's been proven time and time again. So the models are very good at discrete time periods, and they're very good at trend-based environments. They've never been very good at discontinuities or tail risk. Mm-hmm. And I think, going back to what Paco was saying about, trading volatility and how you manage that, you can do that pretty effectively, and you can use modeling very effectively to do that. It's when you hit the discontinuities, the breaks in trend, that it becomes difficult. And the other challenge that you have with the tail risk events, and we've seen it with longevity, go back to those pension funds that were set up in the 1950s and 1960s. People were expected to die at 66. The tail risk was that people lived 20 years longer than that, and that, and the promise that was made had to be then funded. So that was a tail risk that people didn't expect. Climate is another one. But because as humans we have recency bias, we find it very, very hard to look out and price stuff that hasn't happened yet. And even if you look at, for example, European bond markets and how, Italian or Greek yields have moved up and down over the period. Now, things that, 15 years ago were regarded as not quite totally risk-free, but, certainly in a bucket that wasn't that far away from it. You kind of move out to something which is suddenly on the flip of a sentiment change. There's suddenly been priced totally differently. That tail risk is very, very difficult for markets and for humans to price. And actually, that's where insurance companies, for the most part, have been better at looking really far out and pricing that risk. And on climate, we're going to be learning if they're any good at that.
I want to switch gears here in a second. Ken, one more comment, please, on the tail risks you see evident right now.
Well, I want to mention one thing about the title of this, No Safe Asset. I have two younger colleagues at Harvard who wrote a paper about this, but their basic point was if you're thinking of the dollar as a safe asset and your U.S. bonds are a safe asset, you're not looking at history. That whenever you had a leading currency, the dominant currency, could get a really low interest rate, politicians come in, they milk it, and they push it into a region of fragility. I'm not saying it's there, but they keep running it until it's a region of fragility, and when that happens, eventually it blows up. So the idea that there's this big demand for safe assets, they're not necessarily safe if you have a long-term vision.
Just because of time here, we're at 11 minutes to go. I have to switch to a more focused news item right now, and that Sweden, I guess, has said enough. What was the symbolism, Professor Rogoff, that Sweden said we're done with it? I'm paraphrasing, we're done with the negative interest rate model or experiment.
I think they're not. They're just like on pause. That they face the same environment as the rest of the world, and so they're racing very fast towards cashless, or and that puts them in a position to do more. But they have to the central bank cannot do it on their own. It's something the government has to do entirely. And I would say right now it is pretty calm. So take the Fed. The Fed's certainly not going to talk about using negative interest rate policy because the U.S. economy is doing great. Why should they come out and say, something nobody's going to understand and rock the boat? And I think that's probably the case. Sweden's doing pretty well, and so they back off. But if you have another recession, I think the conversation will change.
That's been out there, and so much of the lift may be in that we see in assets as we did not see, quote unquote, another recession. Some, manufacturing trade war, Germany, we all know the story. But to the foundational idea that you need room, higher interest rates, so that when you do have an economic slowdown or contraction, you've got room to move. from where you are, is there room to move within the financial system if we actually get some form of true economic slowdown?
No, I mean, I think that central bankers proved through 2008, 2009 an ability to be really quite imaginative in policy responses, and maybe there's more things that we haven't thought up yet. I mean, more differential interest rate for savers, for borrowers, more imaginative stuff on the balance sheet. I think, there's a hope that there might be some interesting things left in the box, Pandora's box at the bottom. Who knows? But it doesn't. It feels like there's got to be something pretty special that nobody's thought of yet to kind of lift stuff out of there. So I think that sense that we're still, particularly in Europe, we're creeping along in terms of economic growth. There isn't a lot of scope in there. Is there enough fiscal fire that can be put into it or not?
Sorry, but was that a Freudian slip that you said Pandora's box instead of toolbox?
No, I was actually deliberate because I don't think I think QE was a bit of a Pandora's box.
Yes. Okay.
Right. What came out was chaos. Right. That's what was the last thing in the box, wasn't it? Then hope. We talked about hope, but yeah.
Ken has a wonderful paper from years ago at the IMF in honor of Rudy Dornbush. It's just a fabulous exercise if you want to walk through foreign exchange literature. Paco, are you constrained in protecting Citigroup because of the currency system that you're working in, and particularly how is the euro model combined with negative interest rates affected the day-to-day of moving assets and moving finance forward at Citigroup?
I think in the crisis of Europe, the one thing that we had to recognize as a bank, and I think most banks had to, was that Europe was not a country, that you had sovereign risk within Europe and you had cross-border risk. So you could not, cash in Spain was not the same thing as cash in the UK. And if you borrowed in the UK to invest in Spain, you were taking risk that is a risk that you would not consider if you borrowed in New York to lend in California. And I think that is a risk that is latent. I mean, we have now become more relaxed about it, but I don't think there's any coming back from that. And so Europe is one currency, but not one financial system. And so that is probably the one thing that remains from the crisis, and one thing that will reignite if you have another crisis later. I think on the issues that, just I kind of avoid commenting on the issues of Sweden I think my simplistic view is that once you have brought the interest rates to zero, including long-term rates, because monetary policy went from operating on short-term to operating in the entire yield curve, and that was what I think QE was fundamentally. Once you have gone to zero, I think everything else, and if you don't want to go negative because you have tried and the system just doesn't seem to work very well, then everything else that you can do smells like fiscal policy. I don't think there is, even the things that people describe as monetary, if the central bank starts buying assets, goes buying equities, that is fiscal policy. They do something for savers. So I think what you have left is fiscal policy, unless you find a way to go negative more aggressively.
You mentioned this, Ken.
No, that's dead on. A lot of stuff central banks do that they call alternative monetary policy is fiscal policy. A lot of the policies that have been advanced that central banks should do, helicopter money, where you hand money out to people, is a dramatic example. They're fiscal policy, and I think it's very dangerous territory for central banks because they don't have the accountability, the electoral legitimacy. Paul Tucker has a very nice book called Unelected Power, and if they exercise a lot of unelected power, central banks, which are all mostly only relatively recently independent, will get reabsorbed back into the Treasury.
Every year there's a set of phrases, the zeitgeist, and Ken, help us here. How do you respond to the current fiscal space? Is this like money illusion? Is this an illusion that there is fiscal space because it's a proxy for other central bank action?
Well, I think if there's a recession, timely fiscal spending would make sense. That said, I don't think it's going to be a substitute for monetary policy because fiscal policy is not typically targeted and timely. There are different countries. I think there's some countries, maybe Australia, can use it effectively. Maybe Denmark can. In my country, everything is a war. There's no credibility to fiscal policy because everything everything political is knife edge. So one day a law gets passed, the next day it gets undone. I think what's been really a tremendous invention is the independent central bank. I think I would say it's been the most important advance in monetary policy since Keynes. And you can complain about it, you can whine about it, but believe me, if that territory starts being moved back to let's not call it the fiscal, let's call it the political authorities, we're going to have a much more erratic economy. Now, but you asked about fiscal space. If you're going to do investment, education, a long-term thing, well, of course, if it's productive up to a point, yes.
In the repo debate and in the new QE, QE5, whatever we're working on right now, is that just a fiscal process? Is a broad sense? Is that a fiscal proxy?
Well, absolutely. So, again, it's different in Europe than in the United States because in Europe there is no central government. In the United States, when the Fed does QE buying treasury bills, it's a joke. I mean, the Treasury could just issue 1 week Treasury bills instead of 30-year Treasury bills. The Treasury owns the Federal Reserve, lock, stock, and barrel. They own it. I mean, a couple footnotes to that, but basically. And the Treasury bill rate for 1 week is actually lower than the reserve rate that they charge banks. It's just a form of shortening the maturity structure of debt. Now, in Europe, it's different because the ECB is standing in as a fiscal authority where there exists no fiscal authority in Europe. And it has palpably bigger real effects because I think it strengthens the balance sheet of the southern countries. And it's a question of the political limitations of how far are the northern countries willing to do it.
We have 2 minutes left, which is, I thought that was 2 hours, 30 minutes, and I guess it's not. I want to take a phrase from Ken's book, and as we look at no safe asset, as we look at the dynamics of where we are, where we'll be in 12 months. Paco, there's a wonderful phrase where Professor Rogoff alludes to the twilight zone. Are we with negative rates, are we in a twilight zone? And how would you see, what's the urgency to get out of this as soon as possible? What's the timeline you see for Europe to escape from this, and for that matter, Japan to escape from decades of this?
Well, if you use Japan, I mean, you've used the operating word. It's very difficult to get out of this situation. And I think the danger is what we are discussing here, is not having a monetary response if recession happens and losing that tool. But I don't see, quite frankly, I'm not the ultimate expert, but I don't see nominal rates in Europe going up in any significant way anytime soon. So I would argue that the central case is more the Japanese case, where you're caught here for a while.
Ken, within the twilight zone of Japan, how do they escape? Do they need to escape? I had a wonderful conversation with the dearly missed Martin Feldstein on this when he was heated of the decade pain here.
Well, I mean, there are a lot of factors going on besides the interest rate being low in Japan. The demographics are bad, and if you look at Europe, the demographics are a problem that if you solve that, it would help with a lot of other things. I'm a little more optimistic about the future of growth than, I would say the median here and on Wall Street. And I have to say, when I speak to my colleagues in the scientific community at MIT or at Harvard, and I tell them that economists say nothing's ever going to be invented again, like it was 250 good years and it's all over. And a few of the older ones say, yeah, since my paper in the 70s, there really hasn't been anything. But I mean, the younger people just say, you're joking, right? I mean, you have no idea what's going on. So I'm a little more optimistic that this is transitory.
Final word, Ann Richards, with Fidelity. This is a twilight zone. What's the urgency to escape from negative interest rates to bring some normalcy to your world?
Look, I think what Ken just mentioned on the demographics is I think we have to understand better how an aging population and a shrinking population. Japan, there are 500,000 more people died last year than were born. So the demographics really affects the economic framework that we should all be thinking in. It affects behavior, it affects consumers, it affects what type of consumption people want, and I don't think our measurement tools are up to it. So I think actually we have to think much more first about the structure of economies, and then we can think about what the right monetary and fiscal response is to that. And it's that will get us out of the twilight zone. But thinking of this from a purely technocratic point of view and quite a short-term one, rather than just understanding that broader shape, I think is what we need.
Evan, thank you so much for the World Economic Forum. Paco and Ken, thank you so much.
Thank you.